Hey traders, Raghee here. Welcome to, well, first of all, those of you on the live stream here for our Monday live stream, welcome. Welcome to my office and welcome to our futures room. My futures folks, hope you had a great weekend. We should have good audio and video from what I can tell. Should be good to go. All right, let's see here. Okay. All right, I'm going to go ahead and start up my Thinkorswim because what we're going to be doing here for the most part for the next at least hour, maybe hour and 15 minutes, is have a focus on the shorter term time frames. For those of you that are familiar with the way that I like to day trade, the way I like to day trade is to focus on the 1 minute time frames and focus on 5 different pitches between 9:30 and mostly 11, extending to 11:30, but I only day trade the first 2 hours of the day. That is it. If I have an open trade that goes beyond the 11:30 a.m. Eastern cutoff, it's going to be maybe a volume weighted average price type situation, but I'll be managing the open trades. All right. So if I open a new one, which is pretty rare, it's going to be off basically a single setup VWAP allowed initial balance breach. We'll talk about this terminology in our session today. But for the most part, gang, first 2 hours a day, and then that's it. That's it. And I really recommend that because if you do more than that, you're going to find you're going to overtrade. You're going to find you're going to trade through the midday doldrums. You're going to find a lot of bad environments from a volatility and volume perspective are going to become part of when you're going to execute a trade. And you just really don't want to do that. You want to avoid that middle 90 minutes from about 11:30 to, quite frankly, 1:15, 1:30. So it's almost a 2-hour window of that doldrum, that trough in the middle of the day where shenanigans are usually pretty active. All right. So let's go ahead and jump into the morning. I've got the notes here for the morning, and I'm going to go ahead and push them through. Let me get these out to everybody. I'll give this set of notes to you all. These are just for the day. I'll give these set of notes to you all in the live stream as well. So these are our Monday session notes. Okay, and I'm gonna push it through in the live stream as well. There you go. So this is a link, by the way. This is simply a link that once you click on it will show you basically this page. And as I add to it, it will automatically add what it is that I'm doing. Okay. So a couple things to kick it off. We've been talking about this since last Wednesday, a little week ahead of time, that we are coming into the official part of earnings season, which really culminates with Wednesday, the 14th, and looking at the financials. 6 different stocks heavily weighted within the financials are going to have their release on Wednesday. That affects us as futures traders because what happens is that the financials weighting within the S&P, most definitely secondarily within the Dow, is those stocks have the potential, because of the wider amount of movement that we could see, to disproportionately affect the S&P. All right. So we are in the heart of that earnings going into Wednesday. And then, a lot of folks ask me, all right, Rog, but how do we prepare for that? 6 weeks ago. So when it comes to earnings, gang, for those of you that have been with me for a few years, it's a really simple approach. It's a 6-4-2 earnings countdown. And yes, earnings affect futures traders. In fact, a lot of futures traders that somehow forget that they're also stock traders are usually, unceremoniously stopped out of trades fairly sometimes violently because of the fact that they've forgotten that certain stocks and certain sectors have higher weighting within this high concentration universe that we live within. All right. So there's really a window that takes you 6 weeks out. And this is a site that I've used for quite a few years now to remind everybody that you can track this really, really easily. I don't want you scanning the entire universe of stocks if you're a futures trader. I want you focused on the stocks that are heavily weighted within the indices themselves and also the sectors that are weighted within the indices. So that list is going to be the bulk of what you're going to be watching. And again, you're going to start focusing, for example, well, let's talk about the window so you guys have a really clear idea what I'm talking about. So if we have, I'm going to pull up the calendar here on this. This is so ridiculously simple. 14th, right? Go back 6 weeks. 1, 2, 3, 4, 5, 6. March 3, right? March 3, first week of March. That Wednesday, that's when you're focused on if there are any double green trends in the stocks that are going to have their earnings this week. It's just that simple. And so that 642 is heavily dependent on something that really has nothing to do with earnings. In fact, I don't even like considering things earnings trades. I'd rather look at earnings as a caution. We know that implied volatility is going to increase. We know there's going to be a massive volume and volatility event. Earnings. So here's the news flash, gang. Earnings trading is really trend following, right? So keep that in mind as we go through the season. Which markets are 6 to 4 weeks out of earnings that are in trends now? You're just going to have, I think, a lot more attention and probably better follow through to the upside potentially in the double green markets that are going into earnings. All right. So that's been my 642 approach for, well, decades. And we're going to continue to focus on that because it's ridiculously easy. And it's rooted in the things we talk about anyways when it comes to trend following. All right. So the bell has rung. I'll notice one thing right off the bat, and this makes it very aggressive. You'll notice the Dow is right down at its V-score low. You see the V-score low is one of the first setups, one of the main pitches in the morning. We're right here, V-score low. And the other one is, the NASDAQ is down there too. Both the NAS and the Dow. Now, for those of you wondering, is this a gap? Gaps need, what I look for is two confirmations. Not only opening above the close of the previous session, but opening above the high of the previous session. So I wouldn't call today gap psychology. Therefore, I'm not really looking for any intense, pronounced fading, meaning the gap up invites a lot of short selling. I'm not looking for that at all. So the first thing on the morning is the Dow bouncing off the V-score low, and the NAS is very close to that level as well. If you're unfamiliar with the V-score is really simply a Z-score of the VWAP. You might say, okay, Rag, that tells me nothing. Fair enough. What it is a standard deviation measurement of the volume weighted average price. I'm not just looking at price. Far too many traders look at price, and that's just like looking at the surface of the water. There's a lot of things going on below the surface. And so when you look at the surface of the water and price only, you're quite ignorant of what's going on volatility-wise. You're ignorant of time. You're ignorant of volume. And you don't want to be. You want to be a four-factor trader: price, volume, volatility, time. Time, especially if you're a day trader. But time applies this week as well when it comes to earnings. Different high impact hot zones that are on the economic calendar. All right. So with that being said, and if you have any questions, I will be patient with me, gang. I'm in both rooms here today. All right. So a lot of you that have been with me for a while know this is, we're going to look at the V-score lows. We're going to look at the HPMR lows. So right off the bat, we know we're getting a little bit of V-score low action for buys in the YM and then Q. And when I say right off the bat, I mean, it was pretty much at the bell. YM was 930, right at the bell. And NQ was, or is right about now, call it about 931. It really hasn't confirmed where we've touched the V-score. So no touch yet, but very close. All right. So no touch yet, but very close. Now, if it's very close, that means I can look at QQQ calls. I can look at the micro NAS, and you're going to find, even though this is the futures room, I do talk about stocks. I do talk about ETFs. We do use ETF alternatives for the options in situations where I want to be able to control risk. Why is it so important to be a little bit more prudent about position sizing and even the asset class choice now? Well, gang, the market's been open for a whopping 3 minutes, right? We have a giant 18-point range. I'm being completely facetious, as most of you would know, because at the end of the day, the way in which I understand what kind of mosh pit we're trading into is based on historical volatility. And that means that I'm especially aware of what we typically do between 9 and 10 a.m. And I know that the lower end of price movement range, for example, on the NQ is darn near 120 points. Average is about 155. See that there? So until we get up to this area here, this is where we normally operate in the morning. I know the market can at any time expand quickly to those norms. How about the Dow? How about the Dow? What are the normal ranges? Oh, that was the Dow. Sorry. How about the NAS? What are the normal ranges for the NAS? Again, same idea. And here we go. That's the column. That takes us from 9 to 10 a.m. Eastern. And that includes, of course, a 9:30 to 10 clearing range. So again, on the lower end of the range in the NAS, almost 70 points. Well, I believe when we just looked at the chart, 20 points. So the problem with being very aggressive at the bell, and the thing that most traders who get very aggressive at the bell overlook, is that they are right in the middle of this expansion time. Lots of volume, lots of volatility. And when you start to think that the market's put in a low 1 minute after the bell rang or a high 1 minute after the bell rang, that's probably not going to be the case, because we're still in that point in time where this 19.5 point range should very naturally and most often will extend out to almost 70 points. And if it doesn't, that's a different set of problems. That means the market is trading in a way that's contracted and compressed. And there's a problem there, because the market could, again, after, say, 10 a.m., suddenly go back to what it would normally do. And a lot of times, because stops are going to be based on the current volatility, even if it's not historically valid, traders will suddenly get stopped out because they just weren't positioned with their stop in a way to respect what typically happens in the market. This, we can call it volatility, we can call it price movement ranges, we can call them HPMRs, I call them all of the above. But really, if you're trying to compute this in your mind, thinking, gosh, Rog, this is something different and new, what is it? It's what the market typically does at a certain time of day with a 68% probability. All right, so am I in any rush to do anything first thing in the morning? No. However, the closer we get to the lower end of the V-score, this dotted white line here, the more likely I want to be long. Or another way to put it, whatever you do, don't start shorting the bottom of the range. I mean, unless you hate your money, in which case, go for it. But I think there are better ways to make charitable contributions for society than losing money in the markets. Some people trade like the markets are one great big charity. They're not. They're not. So be very, very cautious about seeing markets down near their standard deviation lows and then thinking that a momentum short is going to be great down at those lows. Sometimes it does work, but the probability of follow through is far, far, far lower. And remember, we don't, as they say, they don't call fishing catching, right? We're trading. There's no certainty. It's all probability. Okay, so let's look at, so the question here is, would I take the V-score low? Where would be the exit? So whenever we have a breach retreat, I'm going to be looking normally at, you can look at the opposite side of the V-score. You can look at the opposite side of the range. You can look at the value area high. Same thing that we would be doing after any entry, value area high, clearing range high. Zion? Yeah. Zion view? That's what I would be looking at there. All right. So you want it to retrace its steps, but not really need, your trading plan should not necessitate the market making brand new highs because you're long. That might be a second target. That'd be a really good second target, but it should not be the first. The first target, and I see a lot of traders do this. They have great entries, sometimes better than mine, but their exits stink because they're looking for way too aggressive, if you're going to look at it that way, way too far. That's the easiest way to put it. They're looking for first targets that require new highs, new lows, the market to do something apart from what it had done in recent memory. And whether it's a 1 minute chart or a daily time frame, you just don't want to do that. Pay yourself while you can, not when you have to, is the plan. Okay, so let's see. Do you guys have my notes? And let's see. So questions about overextended markets. Gani, I will tell you this, and I mean this sincerely. Unless the market's chopping, don't worry about a market being overextended. As they say, the market can be moving higher. The market can be wrong far longer than we can remain. Well, what's the saying? The market can be crazy longer than we can be liquid. In other words, don't assume that momentum is suddenly just going to stop unless you're in chop. Now, having said that, you have to break that down to individual sectors and indices. Yeah, the Nas could be toppy up here, no doubt, because the Nas is in chop. The Dow, no. So please don't ever sort of look at the markets, right? Without then asking yourself, is the Dow likely to stop? No, I would not call the Dow overextended because the Dow is in a trend. And remember, overextended or overbought, trends are imbalance. The only reason you get a trend is there's an imbalance. So when everyone says, well, it's really over imbalanced, it doesn't apply to trends. It does apply, however, to chop. So the S&P, that won't apply to. The NASDAQ, it will apply to. The Russell, it will apply to. So when the market's still in chop, as the NASDAQ and the Russell are, yes, you can say that we might be near an overbought zone. That's true. That's applicable. It's accurate, but not on the S&P and not on the Dow. Okay. Thank you. I was completely drawing a blank on that. The market can remain irrational longer than I can remain solvent. Yes. Thank you. I knew it was something like that. Thank you very much. So yes, the market can remain absolutely nuts longer than you can keep from blowing up your account. Thank you, Gerald. Yeah, Trisha. How do I forget that saying? Probably because I make up too many of my own sayings. All right. With that being said, I do not concern myself with that in trending markets, but it is a reality in choppy markets. All right. So what else do we have here? I will tell you guys, I'm tuning over into the Russell right now because I do want to warn you guys about this. I generally don't have a good feeling about the Russell. And here's why. It's hard to get a read on the Russell. And the reason it's hard to get a read on the Russell is because it's not a high concentrated weighted index or ETF, unlike the NAS and unlike the Dow. It is not, meaning the weighting of the different sectors and individual stocks are much more equal. So it's hard to know why the Russell's weak or why the Russell's strong on any given day. The KREs are usually a pretty good indication, but I can look at individual sectors within the S&P, NASDAQ, and Dow and know who's leading and lagging. You really can't do that consistently in the Russell, nor with any real accuracy because there is not high concentration weighting. High concentration weighting is tricky for investors, very true, but it's actually very beneficial to market interpretation and relative outperformance when it comes to traders, right? So high concentration weighting is great for us in that regard. Okay. So yeah, I won't always wander into the Russell and I'll be very hesitant usually about that. And I'll usually be quite hesitant about the Russell if the NASDAQ is strong. Sometimes you'll see an odd little inverse relationship between them. So if the Russell is doing something apart from what the other three indices are doing, in that situation, if the NAS is strong, the Russell usually will be under some pressure. I don't know why that is. Just an observation. Okay, what else do we have here? So right off the bat, we were very close to the V-score low on the Qs or the NQ, however it is you play the NASDAQ. And we did touch right on the open, the down. So very quick, very aggressive, early morning trades to kick off the day. The day is far from done. I know a lot of times as the market starts moving higher, there's a little bit of FOMO. Smother it, kill it, tell it to shut up, whatever it is, because we still have plenty of the morning ahead of us. Is there a chance that those V-score lows were it? Yeah, there's always a chance the market could just rip higher. But I'm going to assume that those rips higher, like we saw into the close on Friday, are not the norm. Look, gang, the way that the market responded on Friday doesn't guarantee we're going to be strong this morning. Friday was one of the lowest volume days of this year so far. And also, if your trading style, depends on a rip like that, which is very uncharacteristic, and they do not happen often. But if your trading style is dependent on those moves, good luck to you, because that's not a style, that's just luck. I look at the afternoon on Friday saying, hey, if you were already long, terrific. That's a disproportionate move that's unusual for that part of the day. And it's usually a move that I'm going to say, well, let's take some profits into. Sure, hold it over the weekend if you like, but let's take some profits. But just keep in mind that if you're reliant on those huge moves at some point of the day, if you require these kind of rips that just keep on going for your style, trading is not going to be a fun endeavor for you. Every now and then it's going to be amazing, but mostly it's going to be pretty difficult. So keep that in mind. Be realistic about what it is you need to be profitable as a trader. Okay, next up is, and by the way, anything that I'm doing in the Dow futures can be done in DIA. Anything I'm looking at on NQ can be done in the QQQ, can be done in the NDX. Absolutely. Same thing with the S&P. So you don't have to have a futures account to look at futures markets and execute ideas off them. A lot of our traders in the futures room, they prefer the options. They'll look at QQQ as the alternative asset class, the alternative symbol, but they'll look at the NQ futures because this is a nice 24-hour market, lots of volume, lots of liquidity, and they'll use this to set up QQQ. So there's nothing at all wrong with that. In the meanwhile, what am I observing? And this is really pretty interesting. Let's see. And if you're hearing all the groaning in the background, that's the puppy not happy that she's in her room. Okay, so I've got a 33-point range. I don't know how much this might picks up. I've been told it picks up every sip of coffee and water in the morning. Yeah, I don't know if it picks up the upset puppy in the other room. All right, so we have a very narrow range in the NAS right now. I mean, we've been open for 17 minutes and we've only got 33 points. We've just made it barely halfway to the normal price movement range low that we would expect. And again, what am I expecting on the NASDAQ? At least about 68 and 69 NASDAQ points. We're at 33. Very narrow range. So that tells you there's not a lot of opinion here this morning, not a lot of, so it's kind of a narrow chop. And that, even this early in the morning, can help us determine whether there's a lot of opinion, whether there's a lot of attention, or if the market's just sort of staying put, staying compact because of, well, any number of reasons, okay? So yes, the V-score lows are still buyable despite the narrower range. But because of the narrower range, I will encourage you guys go with a QQQ. All right, so what would we look at on the QQQs if we were to tag that V-score low, which we keep, kind of teasing that level on the NQ. This would be the second time we've done it. So on the Qs, right? So for NQ V-score low setup, all right, day trading setup, I'm going to look for the QQQ 16 April. So what I'll be looking to do is buy the 16 April QQQ. So that's the expiration for this Friday. So I'll be looking to price that out if and when we hit that V-score low, which bam, we just did. Okay, so I'm gonna focus on the QQQ. Now, we had a pretty dramatic move lower, right? There's no harm in waiting for a minor low or an inside candle, but in the meanwhile, you do want to figure out what strike you're focused on. So I'd be focused on 335. So this would be the 335 call. And I would look to price that. Right now, it's trading 341 by 344. 341 by 344. And so if the market's moving, it's actually even dropping now. Let's see, 335 is 333 by 336. So as it's dropping, leave it alone. Let's wait for the next candle. Let's see if we can't put in a minor low here. In other words, I want to see a squat-bodied candle, a narrow-ranging candle right here. Let's see. S&P has also dropped. You know what? Let's go take a look at the S&P. Keep this one in mind. We're waiting on a trigger. All right, we're waiting on an inside candle or minor low. All right, so I'm still waiting. Here. All right, so then I've got let's go take a look at that S&P. All right, let's go take a look at S&P. So I've got a V-score setup. And I'm looking to buy then the 16 April SPY. And you guys are going to get all this stuff that I'm typing right now on the notes. Why am I pivoting over to the SPY? Because as the Qs drop, or as the NASDAQ drops, it's going to drag the YM with it. It's going to drag the YM. Oh, let me go see what this dog needs. Sorry, gang. Just bear with me a moment. I'll be right back. Just give me one moment. And it doesn't hurt. This market's melting down. Maybe the dog's doing us a favor. Let's keep an eye on this. I'll be right back, gang. Let's keep an eye on this. All right, she's perfectly fine, just ticked off. All right. All right, so we're back. Okay, so I'm just going to wait for this market to chill out, but I actually might prefer the SPY. The DIA is a relative outperformer right now. The DIA is a relative outperformer. So what we can do is focus on the 16 SPY, and I'm going to look at the 410 call. There's your inside. So I would actually look to bid on that 410 is 274 by 276. Yeah, you can even split the bid with a 275 bid. You know, if it's 276 by 278, you can split with a 277. All right. 277, 275 bid on those SPYs, 410. All right. Now, why did I pivot to the Qs? You can do the same thing on the Qs right now. We're getting that inside. Well, actually, we got a minor low on the Qs. But one of the reasons I like the SPY is the Dow right now is a relative outperformer. If the Dow is a relative outperformer, that should keep the SPY in check a little bit more. So while the tech market could continue to drag the S&P lower, the Dow, if it holds its own, is going to keep, relatively speaking, the SPY a little stronger than the NAS. The NAS or the QQQ is perfectly fine. Your trigger for that, like I said, is that minor low or inside candle, and that's going to be valid as we are. So there's your inside candle. I would look at QQQ, that same QQQ, and split the bid ask. Just split the bid ask. So you may not get a bid in an inside candle. So split the bid ask. I don't want you paying up. It's a bad habit. Split that and look to build a position there. So I'm looking at SPY, maybe QQQ, but I like the SPY a little bit better. Now, here's the thing. It's still not, keep this in mind, gang, it's still not 10 a.m. Eastern. So this is an aggressive time to be doing a lot of trading because we still don't have our ranges. We know they're quite tight. The NAS is now, notice how the NAS suddenly expanded. And there's your 68. Remember, we wanted 68 to 69 points in the lower end of the HPMR. And just like that, that's what's happened. So this is why I say you always want to be very cautious until the market sort of put in its ranges, because it could suddenly do so, which it's done. Now, once you're in, now these are all aggressive. This is not what I recommend for new day traders of options or futures. But once you're in the micros, or the ETF options. The micros, I personally pass on. I do not use micros very much. What I'll do is focus on day trading ETF options. So, QQQ instead of NQ. And I'll place, because we're in this still elastic, expansive, volatile, uncertain time before 10 a.m., I'll place a stop with a percentage-based of premium level. So anywhere from 15 to 25%. I'm usually on the kind of on the 25% end. So I know whenever I bought that option, I'm willing to risk 25% of that option across however many contracts I just bought. All right, so that is, let's see here. All right, so what we want to do is focus on the value of what we just paid and accept that we're going to risk a certain amount of that. By the way, I'm in the NAS because it's stalled and chopped around enough. I'm in the S&P, again, SPY, QQQ, and I am tempted to build a small position in the Dow now. So how would we do that? Is the YM down near the V-score low? It's very close. I mean, we broke the V-score low on the NAS and the S&P. So Dow is getting very, very, very close. I mean, achingly close. And we're very close to the 33,600 major psychological level. So on the Dow, this is a YM V-score setup. Again, notice we're using the V-score setup. That's what I call the pitch. This is the setup that we're getting at the moment. And I would look to buy, again, the 16 April DIA. So what's an at-the-money DIA call for 16 April as we're testing that V-score low? This is, again, not a touch of the V-score, very close, so you can at least look at it on YM, but execute the idea through DIA. And I would go with the 16 April 337 call. Your trigger, of course, is the V-score low on the YM. So you might say, Rog, you're looking at the YM, but you're trading the DIA. Yes. Succinctly, yes, that's exactly what I am doing. Okay. Am I using the 2? Oh, yeah, I've been playing around with the 2 versus the 1. Yeah, sorry. I've been playing around with this 2. I didn't switch it on over. Yeah, thanks. I have been playing around with the 2. But we're still pretty close. You can see, and by the way, Zion, Yeah, I've got all the 1 minute charts on the other 9 screens. So my bad, but yeah, we're really close on the one. Same V-score reading. Same V-score reading. Yeah, sorry. Same V-score reading there. I was actually talking with Lorna last week, and we were talking about 2 minute charts. And I just forgot to change it back. But along the top, actually, you guys can see it. Along the top row, here, I'll show you guys. Well, if you're on YouTube, you can see it. Along the top row, I've got all these charts up there. You can see there's the giant microphone. Yeah, so along the top row, I've got all these 1 minute charts that I'm watching. And I know I'm not on the camera in the futures room because, golly, you guys don't need that day after day after day. But, yeah, thank you. Yeah, so Lauren and I were talking about, I use 2 minute charts. There are a couple of things that I do with 2 minute charts, but most of everything I do is on a 1. All right, so anyways, thank you for reminding me to change that though. But no, it's not a mistake in terms of setup because I'm watching some other charts as well. By the way, let me show you, just for those of you that are curious, since I did make that mistake on this particular chart in terms of the wrong time frame. Here is the S&P on the 1 minute, and here is the S&P on the 2 minute. And you'll notice the V-score low and the time that it made the V-score low is no different. You see that? Still a 950 below the V-score, so it's not really going to, in that regard, it's not hurting us at all. Okay? The inside day is going to be different though, right? If I'm looking for that candle pattern, that's where it is going to be different. Anyways, it's still a long. So Dow 337 call, SPY QQQ. First, why are we going with the options? Again, those of you that want to play the micros, no problem. But why are we going with the options? Because we've got the V-score low, because we're quite narrow on the range so far. NAS kind of got back to normal, but the Dow and the S&P are not at all. Russell is fine. Holy cow, Russell's perfectly fine, but I'm not talking about the Russell at all. So we focus on SPY, QQQ, DIA because we're focused on the S&P futures, the NASDAQ futures, and the Dow futures. Now it's 10 o'clock. Now we can see if we can get some what we call breach retreats on the morning. If the market breaches lower, you will see a red line up on my chart telling me that we've taken out the low of the 9:30 to 10 o'clock range. I don't care. I will not be shorting. For those of you that are in the live stream, or those of you that are brand new to the futures room, since November 3, I have kept a bullish directional bias. Now, you can have a bullish bias without an uptrend, right? All trends need a bias, but all directional bias, do not necessarily come with the uptrend. So I am only a buyer when I'm day trading. There are small windows where we might see some two-way trading, but I rarely do it. And I find it's actually very damaging, confusing, encourages over trading, and all hosts of negative things. If you start your day trading career two-way trading, it's just going to be bad. Listen to me now. Believe me later. If you start your day trading career I'm open to long or short, and if you're doing that, you will probably have a lot more round trips every day. You will make your broker very happy, and likely your account very sad. Commissions and fees do rack up, gang. It's a part of doing business, so I don't begrudge it. But why take on more than you need? And so what I'm doing right now is I'm being very selective, being very aware of risk. And I'm looking at my QQQs and my SPYs gain in value quite nicely. My Dow is kind of stuck in the mud right now, which is fine because what am I open to? Initially, at least 15% of risk. On the upper end, about 25% of risk. Okay? So that's what we've got going on right now. And again, it's 3 minutes after 10, for crying out loud, right? Do I need to be putting on full size, going in whole hog this time of day? I really don't. Not any time of day, quite frankly. And right now, I don't feel we have an incredible edge. I really don't. This market's a little wonky right now, not clear risk appetite. I'm sure a lot of people who thought the markets were just going to rip Monday morning because of the way that they closed on Friday are thinking, oh, what just happened? It's called low volume. We had the most ridiculous low volume rip at the end of the day. Doesn't make the move any less real, but it means it's less participated. Fewer people thought that was what they wanted to do. Does that then translate over the weekend? Not usually, gang. So we always want to be multi-factor traders. Price, volume, volatility, time. Yeah. Okay. Let me take a look at some of the questions here. Yeah, my dog wants to be here to support the trading. I think she's a very spoiled creature, as are all the creatures in my home, human and otherwise. And she does not like when she's not around her people. So clearly my husband has stepped out and she's sitting in the room by herself and protesting it. Now, let's talk a little bit about, I've got two trades that are moving higher right now in the SPY and the NQ. And you can see the support we're breaking here on the YM, which is affecting my DIA. But remember, I'm already okay with the market moving about 15% against me, and no more will I tolerate than a 25% of premium move against me. So let's use a really easy number. Let's say you paid 2 points or $200 for your option. I'm okay with this thing going to $1.50, all right? $150. And if I don't like that, guess what? I don't take the trade. Okay, it's just that simple. So I'm okay with losing that if it were to come to that. So let's take a look at the Dow. You might say, Rog, look at that move. What have the options done? What have the options done? So how many of you picked up the DIAs out of curiosity? I keep forgetting this camera's right here, so I haven't bonked my head into it yet. How many of you are in the DIA right now? Yeah. All three, says Jeff. Okay. Mike, you picked them up for two. You knew, Mike, you read my mind. You knew what I was going to ask you, right? You knew. I love it. You paid, let's see, which ones did you buy, Mike? 337s. Yeah, 337s? Nice. Okay. So right now, the 337, you got a slightly better fill than I did. That's nice. Are trading 203 by 212. Am I anywhere near even the 15%? And for those of you that are a little lost, and this is the same, by the way, if you're in my Sector Secrets Master, you caught any of my ETF Masterclass or Sector Secrets free webinars, you know that we use a percentage of premium paid for risk. So 15%, I know that I'm risking about 32.5 cents. So plus or minus 10, I'm not even going to sweat, right? So if you're paying attention to moves that really don't matter, you're going to be distracting yourself, plus or minus 10, 12 cents like we have right now, could care less. When we're down maybe 20 cents, I'm going to start paying attention because that's actually my 15% stop loss. And again, we're trading 203 by 208 on those 337s. By the way, let's talk about, so that's the negative side. I'm never going to shy away from talking about how to manage risk and unrealized losses and losses. I talk about losses a lot. And I think it's very important that someone in my position do that because wins are easy to deal with. I paid myself. It's kind of my job. But losses are the more difficult side of the trade psychologically and mechanically because just we don't like them. But QQQ, all right, so let's talk about the QQQs. Who's in the Qs? April 16, 335 calls. They're trading 366 by 371, 367, 368 by 371. Yep. So those are the 337s on the Qs. They're moving up pretty nicely, aren't they? Not a ton, not a ton. And the swifter they move up, the more that bid offer is going to climb, and the quicker it's going to climb. More volatility is part of the value increase. You know, if an option moves up very slowly and incrementally, the intrinsic value is there. And of course, the value of the option will increase. But when it moves up rapidly, now you've got that volatility, or what I call that beanie baby effect, that demand, that emotion. That is something that is factored into the price of options. And so that's where, you know, if we can continue higher towards the value area high in the NQ, I will be looking to scale out of some of those Qs. Where is that level? You'll see it's sitting at 13.8. I will tell you, we probably want to scale out of about half of the QQQ. All right, let's put this in the notes here. Scale out of half of the QQQ position. By the way, if you bought the NAS futures, no problem. If you bought the micros, it's the same setup. I don't have a different setup for options versus futures. The zones are pretty much identical. So the way we use momentum is very different, though. So scale out of half of the QQQ position when the NQ reaches, I'm going to go with 13,795. We're going to step out in front of the size waiting at the 800 level. So that's called stepping out in front of size. You're kind of cutting the line, but you're willing to do so because you're foregoing, 5 points, because you don't want to be caught up with all the different orders that are sitting at the 00. All right. I want to scale out of the half of the SPY position when the ES reaches 41.17. Okay, 41.17. That's your value area. Your value area high is sitting at 41.17 and 3/4, basically. So we'll step out about 3/4 of a point in front of that. Once we get up that, so as we're moving towards it, we want to pay attention. We're not quite there yet, so I'm just going to sit through some of this back and forth. And then finally, the DIA, we got a long way to go, but that DIA is going to be at about 33,650. But again, notice on that DIA, yeah, we're taking some heat. But when you jump in with the underlying option versus the futures contract, your ability to sort of deal with the elasticity and the uncertainty and the chop of the morning is just more risk controlled, and it's psychologically easier, right? Now, from here on out, if I get a breach, which I haven't yet, or from here on out, if I were to get a V-score low, I would be more inclined to take it with the underlying futures contract. But because the range is still pretty darn narrow, I may still opt to go with the calls on the ETFs. All right, so Trader Mo asked, so you took the micros, Adam? Cool, very cool. Yeah, no problem. So Trader Mo asked, first time in the futures room, am I buying QQQ? Are they naked calls? Yes, I'm long calls. I don't know that a long call, which is naked, is necessarily a problem. It's when you are selling naked or uncovered options. But buying, getting long calls, long puts, your risk is limited. So for those of you that are wondering, naked, oh my gosh, I've been warned about naked options. Naked selling of options is a completely different conversation than naked buying of options, right? And all that naked means is it's uncovered. It's uncovered. If you have an uncovered option that you've sold, your risk is unknown. I won't say unlimited. That sounds so dramatic. You have unlimited reward or unlimited risk. No, it's just unknown. And it could be a lot. But if you have bought an option, whether that be a put or a call, yes, you have a naked long position, but your risk is limited to whatever you paid. Your risk is your debit. That's it. That's it. Okay. So yes, for the day trades, these are naked. Now, if you wanted to put on a call, a vertical call vertical, you could. But remember, that's now 2 legs, and it's a little different an animal. I mean, if you wanted to offset the long call by selling an out of the money call So now you want to sell an out of the money call to offset the cost. That's fine. And the cool thing is that's probably easier to do than a put credit spread in the morning as a day trader, because once the market starts moving higher, I would say you could probably sell an 810 or an 820 out of the money to offset the NASDAQ. No, well, it wouldn't be an 820. Sorry. As we're moving higher, let me say this again, just for those of you that are curious about putting on a day trading call vertical. You always get long the call first. A call vertical is just a choice you can make. You don't have to, but that you can make later on. And so in this case, if I were trying to offset the cost of the Qs that I just bought, I would probably be looking at the 340s for April 16. I'll sell the 340s and try to collect $1.33, $1.35 that offsets the cost, but it also puts a ceiling on my trade. In other words, if we start getting closer and closer to 340, that option is going to be worth more. So too will the option that I bought. But when I've got to liquidate the position, that is going to be a slight loss. Even though it helped offset a certain part of the cost, that 136 by 137, that's going to be higher, right? Most of the time when you're selling options, you're hoping that they're going to drop in value and give you an opportunity to liquidate them at a drop in value, thereby locking in a certain percentage of the credit you collected. Or ideally, and this does not always happen, ideally they just expire worthless, right? But that's the extreme profit example, that these options just simply expire worthless. So that's not what you're counting on. Usually when you're selling premium, if you can collect 50%, that'd be great. So really the offset that I'm talking about here, in my mind, I'm thinking, gosh, if I could offset a half to 3/4 of the value, in other words, I'm going to assume when I got to buy this back, it's going to cost me a little bit. So my offset was about 3/4 of what I collected. Now, if anybody was confused by that, don't worry about it. It's a little bit more advanced, but it is something you can do, which is leg into your call vertical, offset some of your costs. Yes, you're putting a cap on the limit that you could make, but you just reduced your price for the overall trade. And that's not necessarily a bad thing. All right. And by the way, when you are liquidating an out of the money call, let's say you want to get out of the trade, you can liquidate that out of the money call when the market starts moving lower. And that way, you're not going to get the cost offset. What I find most of the time, if you're day trading these call verticals and the out of the money call is not going to expire worthless, again, you're hoping to maybe buy that back at the same, if not slightly higher price. It's going to cost you something. But what you're really hoping for is that the option that you bought, the directional play, is going to more than make up for it. All right, we just shot up to our first target on the NQ. Use this momentum to offer out your half of your QQQ. We're not there on the S&P. The S&P is being drugged down by the Dow, which just apparently tripped and fell over and can't get up. But still, I'm not getting hammered by that chop in the Dow. I could probably exit at a break even if I don't like the way the Dow is moving. And I could exit the S&P with a little bit of unrealized profit if I don't like the way it's moving. And there's no harm in that. Right now, the Nas is in fuego. I like my S&P position. I don't love my Dow position, but I sure love the Dow to play a little bit of catch up. Okay, that is where we are right now. So in terms of pattern day trading, a lot of you might say, Rog, you're day trading options. I do so in a cash account. The easiest way to play options as a day trader is don't get consumed by multi-leg strategies because they take time. And you don't have the luxury of time when you're trading 1-minute charts. And quite frankly, I'm talking about $2 and $3 options. So I don't feel the need to have to offset these trades that greatly. I could step in and buy 10, 15 of these, and they're not terribly cost prohibitive. And remember, I'm risking about 25% premium, but it could be as little as 15. So if you're looking at long calls, long puts, again, naked, long calls, long puts, the easiest way to do that is operate in a cash account. You don't need a margin account to day trade options. You do not need a day trade. As far as I'm concerned, because most of my options trading is simply directional. And yes, people say all the time, oh, but you can't make money unless you're collecting premium. Hogwash. That is not true. 100% not true. When you're going to win and win big in options trading, you are going to be right directionally. Let me use a terrific example. And yes, he used a lot of different strategies, but you guys know, I think we talked about it within the company. John had a big trade in Google. That was a directional play game. Yes, there's some put credit spreads in there. And yes, there were some call verticals in there, but that was a directional play. That wasn't a play where he won big because he collected a bunch of premium. That was really designed to do what? Offset the cost of a very cost prohibitive option called Google. So that's something to keep in mind. Why are you selling premium? Unless you're selling premium as income, which is a completely different conversation, I do that. Unless you're selling premium to build a portfolio, meaning you're selling puts until the market gets down to the zone that you want to buy, in which case you can take the obligation to buy the underlying stock. Great, but selling premium is a very different animal than directional long call, long put. And if anybody says you can't make money doing that, that is the biggest lie that's consistently told to options traders. How about they tell them the truth? Quit under collecting when you collect premium and quit overpaying when you buy puts and calls. That's the secret. And know that if you're collecting premium, you're doing so either for income or you're doing so for a cost offset of your trade. And a lot of times traders forget that. They forget the job of that collecting premium. They forget the job of that directional play, and they get the timing all off. So timing is really important for options traders. Case in point, as this market was moving up through 795, if you're looking at time and sales on the QQQ, the trades were going off at the offer. That's where you want to park yourself. If you are waiting for the market to come back down, you're going to end up struggling at the bid with everybody else who's trying to liquidate those calls. So you have to utilize momentum as an options trader. And you have to make sure you're using it to your advantage when you're buying and when you're selling, when you're offering out. So I hope that helps. Okay, so first thing, NASDAQ hit it, so I'm feeling a little bit better about the S&P getting to 4117. But what is that S&P going to need? It's going to need this darn Dow to get out of its way. So let's talk about what the Dow needs to get out of its own way. It could be, I think what it's going to need is a breach of basically 622. If we can breach 622, we will have just put in a bottoming 1, 2, 3 pattern. I'll show you what that looks like. We'll just put that in. It's a reversal pattern. 1, 2. And what I'd like to see is we break this swing high. We'll also be breaking the wave. So if we can get up on that side of this pattern, that should bode very nicely for follow through to the upside. All right, so Dow is sort of in the way right now to my follow through, not only on the Dow itself as DIA calls, but also on the S&P. The S&P is a little bit stronger than the Dow because the NASDAQ is pulling it higher. And I remind everybody, when you're trading futures, my gosh, don't make the S&P your primary determination of what the markets are doing. People say, well, I watch the S&P because it's a broad-based understanding of the market. No, that's actually a very misleading statement. And I get kind of punchy about it, as you can see. It's a very misleading, if not downright stupid statement. And here's why. The S&P goes where the NASDAQ and or the Dow let it, or where healthcare and financials let it go. In other words, the S&P looks like, in the first 5 stocks, a second-rate NASDAQ. It's weighted a lot like the NASDAQ. It's weighted a lot like the NASDAQ, a lot like the Dow. So yes, the statement is true in all fairness. But it's very misleading because then it somehow suggests that if you watch the S&P, you know where the markets are largely going. That is untrue. That is untrue. You look at the Dow and the NAS to find out which one the S&P is tracking with to get an understanding of where the markets are going. And if the S&P is capable, rarely, on those occasions where it can kind of go its own way, like a great Fleetwood Mac song, it's going to be because financials and healthcare are moving, and they're able to overpower the influence of tech. Now, if tech is strong and financials are strong and healthcare is strong, you're going to have one of those days where the S&P is likely going to outperform everything. Okay, so here's our S&P. I think we're 1 point away. Give us one more stinking point. On the surge higher, here's what I need you to do. Head back on over to the SPY. Pull up that April 16 option chain. Go back to spot. Go back to those 410s and you'll look, they're trading 307 by 309. As the market moves higher, the offer and the bid, the ask and the bid are going to continue to move higher. And with bullish momentum, you're more likely to be able to split the bid offer, meaning put a number in the middle, or sit on the offer and get your fill. That's it. Now, you might say, Rog, it's a very narrow spread. It's correct, but it's a habit. It's a habit. If you habitually always pay what the offer is, and if you habitually always give the bidders what they want, when the spreads do get tighter, you've already built in this habit of just going right to the bid or right to the offer. Awful habit. Take control of your order flow, route your order flow, and the main way you can do that is by paying attention to momentum. All right. So we're trying to get there. We just popped to a high of 41.16 and a quarter. So we'll keep an eye on that. Okay, so yeah, gang, even though I'm using a 1 minute chart and I was erroneously using a 2, if you use a 1, a 2, a 5, it's not that big a deal. It really isn't. I don't want you thinking, oh my gosh, I don't want to trade 1 minute charts. Everything that we've done so far has been based on readings of a tool that actually prioritizes volume over price. We're using time, and we're using the clearing range zone. And whether you're looking at a 30-minute candle, quite frankly, or a 1, the high low of the clearing range is the high low of the clearing range. So if the Dow could move higher, like I said, take a look at the Dow. We're trying to get through that 620 right now. We're trying to complete that 1, 2, 3. This should bode very well, not only for the Dow, but this should let the S&P run towards that 41.17 as long as the NASDAQ is still moving higher. And the NAS right now is struggling with that 13,800 major psychological level, which is why we stepped out. Remember, step out in front of size, be for it. Okay, so looking good there. All right. Can you play? So question here. Hey there, Glenn. Great question. Can you play SPX? Glenn, this is where I say you can absolutely choose your own adventure. Micro S&P, S&P, SPY, SPX, all perfectly valid. Absolutely, all perfectly valid in that regard. It's really just whatever you're comfortable with. So if you want to play the SPX, yeah, feel free. Yeah, I don't ever want to tell you have to play the futures or you have to play the micro, or you have to play the SPY. No, not at all. You can play the SPX, sure, and you can play the expiration that expires today. You can do those zero dated. Yeah, absolutely. Because they're Monday, Wednesday, Friday. Go with the zero dated. It's a day trade. It's a day trade. So you would have been looking at the 40. You would have been looking at the, as we kind of dip down in here, yeah, no harm in that. No harm in that at all. As long as it's not cost prohibitive, no harm in that. So if you're using SPX, go ahead and use the zero date. No problem. Even on some of the options, you'll notice as long as there's liquidity, if you're wanting to use a Wednesday expiration in lieu of the Friday, no problem. But on the SPX, NDX, zero is fine. Zero is because you're gonna be out today, preferably, hopefully by noon, right? Hopefully by 11:30. Actually, that's what I prefer. Okay, so. What else do we have here? Let me grab a few more questions. Do I use tick charts? No, Patrick, I don't. Not that there's anything wrong with them. I just don't. All right. How often do I do my live trading in this room? Jeff, I'm on the mic with you guys every other Monday, Tuesday, and Thursday. Every other Monday, Tuesday, and Thursday. But if I have trade setups, I will send them out as alerts, because one of the things that's actually quite realistic about the timing of the types of trades that I'm teaching you guys to recognize is that they're not now entries, right? They're not now entries. We're not flipping in and out, in and out, in and out, nothing like that. It's very realistic for me to say, hey, let's look at a V-score low or an HPMR low or a breach. level and tell you to put a limit order out there. So today probably wasn't a good example of that, but on the days when I'm not on the mic and I've got the ability to say, look, I think this person could probably get the alert on their phone or in the chat room and place the limit order, because we only want to use conditional orders for our trades. Limits, stops, never market orders. They are the tool of twitchy overtraders. Stay away from the market order. Do yourself a favor. Listen to me now. Believe me later. Market orders will only get you in trouble. And the few times they get you in a trade are going to be far outnumbered by the times that you're in lousy trades with lousy fills and over trading because you're just a dopamine junkie. And there's a lot of traders who are actually, junkies. Dopamine, boom. You know, this thing does it too, right? These darn phones, same thing. Can you play the leverage ETFs? Glenn, you can, sure. But the setup's the same. And Glenn, not only could I tell you that you can play the micro mini, levered ETFs, SPY, SPX, I'll even say that once you start to understand this a little bit better, and yes, the markets are selling off right now. I'm a little disappointed by that. I was hoping to get 41.17. I guess I could have put in 16. But anyways, I'll sit through this. What am I losing? Unrealized profit, which is really kind of a disappointing thing. But we're in. So right now, for those of you who are wondering what just happened, between 1025 and 1035, we tend to have some wonky reversal action in this 10-minute window. Relax. Look at the clock and go, oh, it's 1029. Got it. We're in that 1025 to 1035. Let the market kind of throw its little hissy fit. This is like the 2-year-old at the, or 3-year-old, whatever, throwing itself on the floor at the grocery store, having him or herself a little tantrum. Just leave it be. Don't freak out, because it's happening in a pretty normal time for this volatility. It's a little 2-year-old tantrum. You just let them, not that I know anything about raising kids, but I've watched plenty of tantrums, usually at restaurants. All right. So do I use 1 minute for day trading options? I use 1 minute for day trading, period. All right. Why would I let unrealized profit escape you? Because nobody knows where the markets are going, Jonathan. If you have a threshold for where you'd like to take profit, do it. Yeah, do it. Absolutely. But here's the thing, Jonathan, nobody knows where the markets are going to go. What I try to do is place a pretty conservative initial target and move the stop to break even. So like on the NASDAQ right now, because it did hit the upper end of the range and I was able to scale out of my half of my QQQs, I've got a break even stop now. So that's another thing to put on the notes. So yeah, we missed that target on ES by 3/4 of a point, but I'm going to let this market get through this little tantrum. It happens. If you're taking profits quickly all the time and you're not scaling out, you're going to miss out on great big moves. And I like the great big moves. And I don't think that 41.17 was something that was too out of line. But yeah, if you have a different way to recognize that the market could be exhausting and you're thinking, Rog, I know that's not your level, but I'd like to scale out of some of my position here. Oh my gosh, please do it. Yeah, of course. Please feel free. If you looked at that high in this area and said, gosh, Rog, 41.16 looks pretty darn good. I'd like to get out. Please don't let me override it. Just don't scale out too rapidly. Please. You're going to miss out on some really great opportunities if you do that habitually. And I don't think necessarily, for me, one thing I might say for you guys to do, if this market's going to act all sorts of wonky today, which it sort of is, if after 1035 you want to move the S&P to a break-even stop, I've got no problem with that. If you want to risk maybe a nickel or something very small, if you want to move it after 1035, I'm fine with that. So let's put in some notes here. Once the first target is reached, the remainder of the position is break even. In other words, for an option, it's what you paid. Give or take a nickel. That's going to plus or minus a nickel. I'm fine with that. Today, after 1035, since we missed our ES first target, by 3/4 of a stinking point. I mean, it got close enough to say, well, in the spirit of what it did, that could be a level where technically we should maybe be at a break even. So after 10:35 in just 2 minutes, since we missed our ES target by 3/4 of a point, I am bummed about that, but it happens. I can move my stop loss, break even. And in this way, it's like the S&P trade didn't even happen. Yes, I gave up some unrealized profit, but still, at the end of today, with any luck, I'm going to have a nice NQ winner on my hands, a break-even ES. And, I'd like to see this market move back up. Let's see what happens after 10:35. I'd like to see the market hold the lows that it's put in, but I don't have a problem with that. Okay. Again, we got very, very close to our target, which tells me I think the target was well placed, but the market does what it wants to do sometimes. So I don't have a problem if you guys want to move stops to break even. Or in the case of the DIA, use a negative 15% stop loss. Oops, sorry, hang on. Oh, there we go. Use a negative 15% of premium paid stop loss. Okay. We can keep the risk pretty low at this point. It's 10:34. We can keep the risk pretty low at this point if we'd like to. All right. No harm in that. And this is a pretty choppy morning. This is not one of those mornings that I think people who saw Friday's close were anticipating. And again, this is what happens when markets rally very strongly going into the end of the weekend, or going into the end of the week, going into the weekend on low volume. It wasn't like we had a mass volume move that sent that market sharply higher. Not at all. Volume matters. If you're stuck still looking at the markets at a price only, you are going to miss out on a lot of understanding of what's really going on, because volume and volatility, as well as time, matter a lot. So speaking of time, now is when I'd like to see this S&P start to level out and start to move back up. Even if it's in a choppy range, I'd like to see it start moving back up. And, I don't even know the way that market moved. I wonder if it was a bit of news. If we got a little bit of a headline or something on CNBC, who the heck knows? Or if this is just kind of noise based on going into earnings, or what? Yeah. So I'm just looking to see if there's anything news-wise. No. I don't see anything. This chip shortage thing is really a thing. This chip shortage conversation, we'll be talking a little bit more about this in the mastery. You're not seeing it play out in SMH yet. Chip shortages don't immediately mean it's going to be bullish for the underlying semiconductors, but this might be an interesting scenario going forward for us. Really interested in that. Let's see here. Yeah, exactly, Lorna. There's my tantrum. Yeah, you're quick on those GIFs. GIFs. All right. So S&P rolled over, Dow sort of holding its own. Now it's hit our target. Choppy morning. I feel pretty lucky to be in a situation right now where I realized a profit on one trade and can move to very tight, if not break-even stops on the other two. Because when you step back and look at the action since 9:30, it's just been a back and forth mess. So I feel pretty darn good about not having put in an inordinate number of trades, and also right now being at a spot where we can say, you know what, tighter stops and or break even, and we can be covering ourselves and walking away with a mild profit. So I am excited about that, especially when I look at this action. Oof, this is ugly. Not because it's up or down, because it's not really going anywhere. And again, remember that we talked about this earlier before we even saw this crazy price action set. These narrow ranges were sort of a heads up, right? That's why I was spending so much time explaining the ranges to you guys. It's really important, you know, and I think it'd be even more important for me to point out that on a day like this, if you can tighten up your stops and leave with a little bit of a profit by the time 11 o'clock rolls around, for me, I'd be very, very happy. Because I think what happens to a lot of traders is they're going to either get false breakouts on the long side of the upper end of the range, false breakouts on the short side on the lower end of the range, and that's called a whipsaw, or we're just not getting follow through, you know? So I'm pretty content with, again, how we've shifted break even to either a 15% premium. We've taken out profits on the NQ. That's already at break even. Let's just make sure we don't go negative on the day, and that we can walk away having covered cost, putting a little something in our account on kind of a wishy-washy day. All right. But again, I'm not done yet. I'm just making sure you guys have some management ideas in place. As far as where you sign up to join us, you can head on over to simplerfutures.com, and that is where you can take advantage of the $7 trial. Okay. And again, just keep in mind that there are 4 other traders also you get access to in the futures room. And I do the open every other Monday, every Tuesday, and every Thursday. All right. So let's see what happens here. It's 10:40. I'd like to see this market simmer down. It really hasn't yet. And I don't know what seems to be upsetting the market at the moment. I don't have television on, but just looks like, again, just sort of the back end of a ridiculous low volume rally going into the close. And again, that's a fantastic play if you were long that afternoon. Kudos for that. But you want to take that profit when you can, not when you have to, and not go under the delusion that a low volume rally is something you take into the weekend, or you do with a very, very small part of that position, having already paid yourself and scaled out. That's how important volume is, gang. Can you still take V-score lows now? Great question, Zion. You can. You can. Here's what I'll tell you. I still have some QQQs. Yes, you can take advantage of some NQ. But the reason, if you're wondering, Rog, why haven't you said let's do that? Because it doesn't invalidate it, but it will make placing the stops a lot more difficult. We've been flirting with the red. So if we go double red, meaning red over red on our JT score, oh, this is the JT trend plus the V score. We start going red over red. You know, one, that could be a big no for many of you, but it could also be a reason to remember that placing stops in this environment of red is going to be far more difficult. So I was watching the market go lower, lower, lower. I'm thinking to myself, this market's going to go double red. So if I'm going to do anything, I'll probably shop the QQQs again, just so I can keep this narrow range that we're trading within, the NQ at 67 points, and just basically have a much more defined look at risk and a much more elastic position if the market volatility suddenly expands. Again, having been this choppy, remember, gang, we have not even breached. We didn't take out a breach high. We did breach the downside in the Dow. I'm not looking at shorts at all. It's long or long only. But once we go double red, as you can see here at the very bottom of the screen, that is the measurement of the 8, 13, 21, and 34 EMAs. And once we go double red, and we know that not that the buy can't be taken, but the way in which the weakness is still sort of the dominant psychology is very much in play. So we anticipate lower lows in that environment. All right. So next up is, so if you're wondering, Rob, no V scores, I don't like the structure of the market. Narrow range, choppy. I just assume take the QQQ profit and make sure everything else is tightened up. And I'm going to probably pull the plug on all this right about now. And that's fine. That's fine. At 10:43, I'm still up a little bit on the day. What more could I want on a day like today? You might say, well, you could be short. Again, shorts are a low percentage. Shorts are a very low percentage play. And those of you that might be wondering, is the market concerned about earnings on Wednesday? Now would be a little too early to start the market doing that. I think what the markets are saying is that rally that we had on Friday was pretty ridiculous. And now that we're getting size and more opinion coming into the market, they're just taking that ridiculous rally back. That's why low volume rallies have got to be, you take profits in those moves when you can, not when you have to. Really important. So then now you might say, well, what about tomorrow's CPI? Is the market concerned about tomorrow's CPI? Remember, the Fed keeps saying there's no inflation. And the truth of the matter is, if we start to see inflation heat up, the Fed is under a little bit of pressure because at that point, they might need to tighten up the accommodative monetary policy. The stock market would hate that. So CPI being one of the 4 major macroeconomic pillars, okay, that maybe the market's playing a little bit of wait and see before that release at 8:30. Maybe. I think this is really more a culprit of, let's step back and look at the daily, shall we, for a moment? Because it's so easy to get lost in the shuffle of the 1 minute, which feels so dramatic. That's your candle today. Today is actually technically an inside candle. We did not make a higher high than Friday, and we haven't made a lower low. We are stuck in the range of last session, the Friday session, and we're just actually going a little bit lower because I think a certain segment of the trading population said, yeah, let's take back some of that low volume nonsense from Friday. That's it. I wouldn't fade it because of that. Today could have rallied up again, but it just isn't. So what else do we have here? Let me make sure so we spent a lot of time talking about risk and trade management before this happened. So remember, I was talking about managing risk while we were still anticipating the market moving in our favor. Why? Because if I haven't at least discussed it with you and even myself, I don't have a plan of attack that I already feel very comfortable. I've already accepted unrealized profit loss. I've already accepted a small loss. If you've already gone through the process of imagining what would happen if X, Y, and Z happen, when it happens, you've already accepted it and you're less likely to play all those shenanigans of, well, let's see how much longer it could go. Well, it could bounce. No, just get out. Just get out. Your job is to make money. Your job is to put that money in your account and then keep the markets from taking as much of your capital as possible. Today, that's not going to happen. That's what I want to, even if it's a break even, which it shouldn't be, but that's what you want to focus on. All right, next question here from our live stream. So yeah, if you guys decide to sell premium, remember that selling premium in the same zone that I'm getting long, the debit, the timing is usually pretty right. So for those of you that are wondering, Rod, can I sell option premium, collect credit, because that's just what I'm more comfortable with, versus getting long the debit, as clearly you're more comfortable with? Yes, because the momentum that I will be buying a call into is the same momentum that's going to help someone who's selling premium collect more premium. Isn't that funny how that works out? So the decision level is very similar. The zone is very similar. The action that you can take at it can be what looks to be absolutely the opposite. But in reality, it's really not opposite. It's really just capitalizing on a different angle on the trade, right? So bearish momentum means I'm going to pay less for the option, and bearish momentum means I'm going to be able to collect more for the put that I'm going to sell. So no problem. As long as you understand the momentum and what it is going to empower you to do. All right, but notice again, we had our scenario for risk laid out well ahead of the scenario that would take us out, so that when that starts happening, which it could, we're not, caught like a deer in the headlight. Most of risk management, gang, is not fancy risk management numbers and percentages and all these fancy things. Most of risk management is just accepting that at some point you could be wrong in the trade and just taking your medicine. I'd love to say risk management is this fancy thing. It's really not that complicated. Determine how much you can afford to risk, have that number and that percentage handy, calculate it out, know the validity of your trade, and if and when that scenario starts to materialize, you've already accepted what the reality could be. Get out. A day trader's option, futures, whatever, a day trader's best friend is the very next session. Because if today's session was, well, it was all right, moderate wins, yeah. Remember, as long as you walked away with a profit, that puts you in a very select minority of traders, and especially in this environment. And the very next session, you got another chance to put all these ideas back to work again. So I think the easiest thing for day traders is the fact that you're going to have a fresh set of HPMR potential tests and V-scores and clearing range breaches and all that to deal with tomorrow, where for end of day traders, they may not get another opportunity to buy a dip or sell a rip again. So for day traders, that's actually a terrific privilege to have the ability to say, well, I just get to do it all over again tomorrow. Use that to your advantage and don't overtrade today. And look how this market's bouncing up. You know how many people probably got short in that? And now they're getting their faces ripped off. That's what they call that. I don't know if that'd be a face ripper, though. That's a pretty quick ascent, though. I know. What a horrible Hannibal Lecter way to describe it, but that's what it's called. Anyway, that's why I don't want to be short. Okay, as a general rule, because the path of least resistance continues to be up. So rather than short the market when it heads lower, I'll look for lower lows to be long from. Okay, so let's then take a few more questions here. Okay. Do you guys have the notes? And I'm kind of keeping up with all this as we're talking. So hopefully this will be a good reference for those of you that do catch the replay later on. If I have a smaller account and don't have the margin trade for the majors, what grocery, what would I recommend? Trader Mo, I mean, I think grains are generally speaking going to be pretty affordable. Lots of currencies, believe it or not, are pretty affordable too. So the indices are awful. Yeah, the indices are awful. Even when we're swing trading in the futures room, overnight trades, I'll recommend taking the options. Options on the ETFs or options on the futures. But as far as grocery store, you're going to notice that grains are fine. Meats, generally speaking, are not terribly expensive. My favorite, copper, is not terribly expensive. Some of the currencies are very affordable. So there are plenty of things if you don't have a ton of margin. But I would say also you might want to look at the options in lieu of that, the options on some of those contracts, because the options on some of those contracts are going to be more affordable. And then you can put a percentage base of value stop loss on those. And that way, you know what the worst case scenario, give or take gaps technically would be. All right. Okay. Let's see here. I'm pretty much done day trading. So I'd love to take some questions on some, other markets. I'm perfectly fine with that. Look, gang, don't just become a day trader. There's nothing wrong with day trading. But don't just find yourself focused on these four indices. Maybe I look at crude oil and I look at some currencies as well. So I have another screen over here that I'll look at it on. But don't just get fixated on 1 minute charts and day trading your life away. There are terrific opportunities on end of day charts too. So let's talk about that. A really good example is as this market was pulling back, even this last pullback on the 25th, that's a terrific opportunity to buy further dated out SPY calls. You may not want to go the ES route because, like I said, it's cost prohibitive. How cost prohibitive? Well, let me show you. This is a $12,100 initial margin contract, meaning to take this contract overnight, hold it for days, maybe weeks, it's $12,000 and change per contract. For some traders, that's just not going to work. That's fine. Day trading margin for most brokerages is anywhere from 25% to as little as $500 per contract. So the affordability of day trading is, of course, very appealing, as are the tighter stops. So if you do lose, it's going to be usually based on the volatility ranges of 1 minute candle charts, not daily candle charts. And here we are heading back up again. Again, this is a very wonky It's a very wonky day. So far, it's been a very wonky day. But again, I think that I like the buy that we had. The only one that I'm a little upset about is I don't know why we couldn't ping 41.17. That would have been great. If we pinged 41.17, I actually would be pretty darn happy. That would have been, I think, a really good morning considering the price action. All right, back to longer term time frames. So indices are usually very cost prohibitive. Copper, which has been a market that I have been watching quite closely, copper is not cheap. If you've got a $7,500 or $10,000 contract, it may not be great because it's a $5,500 contract. So buying one contract of copper would pretty much tie up your account because I would leave that other 2,000 for just cushion. Not for potential losses in copper, but for just cushion. Because at that point, you're well over half of your margin use. But let's say you're looking at corn. And by the way, gang, once upon a time, commodity futures end of day swing trading was very easily done on a $10,000 to $12,000 contract. Yeah, $10,000 to $12,000 account, even $7,500 to $10,000, because the margins were so much lower. When I was first trading corn, my margins were about $400. Now it's a $1,600 contract. A lot of these grains and softs were like cotton was expensive or coffee was very expensive, but cocoa you could trade for $500 to $600. Corn, cotton, cocoa, wheat, they were in that low mid, call it around $500, $600, sometimes $700 margin. So, it's a little different now. I don't find corn at $16.50 cost prohibitive, but it's a far cry from the memories that I have of trading corn and oats and wheat and beans. The bean complex was a little pricey amongst grains. So this is reasonable for $7,500. Yeah, this is very reasonable. What about bean oil? I like the idea of bean oil. A little bit better than beans. A little bit better. Because the structure's been a little bit better. Reflation trade, absolutely. So actually where beans are now could be very interesting to start looking at long calls or getting long the soybean oil contract. $1,600 or $1,700 to control that contract. Soybeans, testing the 55 again, the 5,500. Now soybeans, they're a $3,600, almost $3,700 contract. So soybeans are not cheap. Bean oil for a lot of you might be the better way to go. The soybeans are down testing the 55. The reflation trade, gang, I will tell you, as much as I think the environment is still intact, there's been an unwind. There has been, or I wouldn't say a massive unwind, but there's been a little bit of sort of apathy towards it. People have been getting very excited about the resurgence in tech. And as soon as that happened, it seemed to have hurt your financials and energies. It seems to have hurt some of these markets that were en fuego up until then. So the market's always going to have its attention, usually in a handful of places. And when one starts acting up, our attention isn't going to redirect to that new thing. All right, to that new thing. What else do we have here? Is the tossed URL for my workspace in the index futures? Craig, no, not exactly. The indicators that I make available for free in the room drive, those thing scripts are, but I have a number of premium tools on this layout. So therefore, no, it's not. This layout is not available because of the premium tools, clearly. But the individual tools that I do make available for free to members, all those thing scripts are there. So you do have a very similar chart that you can put together, sans the premium tools. Okay. Let's see here. And I will be 0% surprised if this market continues to head higher. But again, I'm happy that I took a little something out of it. And Tomorrow's another day, and it's 11 o'clock. So I'm winding down, right? I'm winding down. I'm not gearing up for a whole bunch of trades. And how many trades do we put on here today? Three trades, 3 options trades. I was just eyeballing crude, bouncing off its HPMR zone, its hourly price movement volatility zone on the 1 minute chart. The only reason I didn't call that one out is it went double red. Otherwise, I really liked it. As it was sending, I mean, it was moving lower, 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 lower. I'm like, oh, this is going to go double red. It wasn't at the time, I will say, but see, this is what I get for front running my own approach, because actually at 51, it was just yellow. Even at 52, it was. So that would have actually been a decent little buy. Yellow, JT trend score for the 34 EMA wave, trading down into the hourly price movement range. That's not too bad, but I don't love it. And I less like the time of day. I'm winding down. We're not winding up. We're not finding a whole bunch more trades to take, going to lunchtime doldrums. That is the exact opposite of what we need to be doing. So we've kind of done most of our activity early in the session, and then we're winding down as the session is also, from a volume and volatility standpoint, also winding down. What are my favorite commodities to trade? So Kim, since you're in the futures room, in the evenings when I have an update to my longer term setups, you'll find that in the premium video that I have available to members in the dashboard, check that out because I walk through that in a lot of detail, but pretty much what we're talking about now. I am interested in silver, and I've been talking about silver a little bit. We could be seeing a 1, 2, 3 bottoming pattern on the daily time frame of gold. And I think we could also be seeing a 1, 2, 3 bottoming pattern on the 30-year bond. I think we're actually looking at that potential. Grains I still like, beans, corn, bean oil, mostly. We're still looking at meats. Energies, I really like crude. I know crude's been sort of stuck in a range in a big, big way, but I do like crude oil longer term. It's up today. That makes me happy. It's just pulling back a little bit, but it is up today. So we've been talking about longs off the bottom of the range in this sideways action in crude. So those are some of the markets that I like right now that aren't named NASDAQ, S&P, Dow, Russell. All right. Let's see. AB, we do have a number of masteries. Yeah, so it's just a matter of what kind of service you want. Now, if you want to day trade futures, you don't need a mastery. You can just join us here, right? Depending on what it is that you need. If you do want a mastery, then I would say, go take a look at the trader. Make sure it's a trader who you resonate with. You like the way that they trade. And then for the most part, my mastery, and you asked about John's as well, those are both options trading mastery. So we're not going to be doing a bunch of futures day trading or really day trading at all in those. If you're looking for more short-term opportunities, I think the main rooms are going to be where you're looking for that opportunity. But if you want to be an options day trader, look, I'm doing some options day trading here, but it's predicated on what I'm seeing in the futures contracts. So I think the most important thing is just to find a style that resonates with you, something that's realistic. And then find the trader, and there's a lot of masteries, of course, but you might find for a little while, take a trial in one of the main rooms, and get to know the individual traders through that exposure. And same goes for those of you that are in the stream. If you're trying to figure out, gosh, Raghee said there's 4 other traders that are with you in the futures room. I'd love to learn how they do stuff. Great. Come take a trial in the futures room and check out what our traders do, because we're all quite different, which is both good and challenging, because you're not going to get the same kind of coherence from trader to trader, but you do get exposed to, in total, 5 different types of trading styles, which is cool because now it gives you, in a very short amount of time, the ability to watch 5 different traders navigate the markets, long and short term, and you go, oh gosh, I resonate with that person, right? All right. Cool. Yes, I agree, Rick. The excitement in tech seems to have really, I don't think hurt everything else, because it certainly doesn't hurt S&P. But I think it's definitely taken some of the attention away from other markets that were stronger. I agree with you. I agree with you. So when I talk about double green, right? Question there. Hey there, Shaw. When I talk about double green, what on earth am I talking about? I'm talking about these two rows of colors at the very bottom of my chart. So double green is green over green. And the top indicator, or the top row, is the 8, 13, and 21 EMAs. The bottom is the 34. So I'm looking at the relationship of these exponential moving averages to one another. So when I call something double green, that's what it is. I'm being quite literal about the color of those, whatever to call them, rows. I'm being quite literal about the color of those rows. The banks are going to be difficult to make any kind of law. I'm not interested in banks until after the Wednesday hot zone. We have all the earnings coming out. Remember, we've got a hot zone of CPI tomorrow. We've got the earnings on Wednesday. So I would steer clear of financials and individual bank stocks for now. Maybe after. Remember, we talked about this in Charts and Coffee, and this is really, really easy. I'll walk you guys through this real quick. I did a video on this last Wednesday, and that is, gang, as we are going into earnings, I use this is what I've been doing and sharing with you guys for years. I use a 642 earnings approach. That means I'm looking, that means to start looking for, well, back to double green, right? Glad we covered that. Double green trends 6 weeks from earnings. This is ideal for the rally into earnings. But please remember, double green pullback buys are what I would do with or without earnings. So all that a double green 6 weeks out before earnings really is just a little bit more intense attention and the possibility for a little bit more of a timely rally within a very identifiable window. So I know that 6 weeks out, if I've got a double green, put that on my list. In fact, start thinking about pullback buys that far out. You're going to see about 4 to 2 weeks out. That's going to be your sweet spot. Why do I cut it off at 2 weeks? Because after 2 weeks, what you have is the implied volatility starting to move higher. I really don't want to be buying a lot of options in that window, even though I'm going to be flat before earnings. This whole run, it's into earnings, not through earnings. And so I'm looking for that window to take me really ideally no less than 2 weeks out into that earnings date. Remember, the other challenge inside 2 weeks is I need the market to pull back, fill, follow through within a very short amount of time, 10 trading days, basically. So I'm running out of time. I'm running out of usable sessions for the market to do everything that I need it to do so I could be out by earnings. The other thing too, okay, there's only 3 ways really to trade earnings. You can play the rally into. You can collect premium inside of 2 weeks because the implied volatility is increasing and play that game. Or you can, usually a popular thing to do is straddles or butterflies if you're looking to play through earnings. All right, so that's really the only 3 ways you can do it. Play that binary volatility event of the release itself, sell premium into the release, or play the run-up. I like the run-up the best. I don't want to be in the volatility of earnings. Very seldom am I. Very seldom. So financials bring that, banks, financials bring that topic up because that's coming up day after tomorrow. And it has an inordinate effect on the S&P. Look at this market rallying higher again. Holy cow. Look at the NQ trying to take that ES with it. Why is the ES acting so lethargic? Because the Dow still can't get out of its way. Still. My gosh, Dow. Dow clearly had decaf this morning for breakfast, and I clearly did not. All right, let's see what else we have here. This darn necklace of mine is itching the heck out of my neck today. Hang on, it's really cool. It's wooden. It's made of wood. I don't know if you guys can see this. It's beautiful, actually. You guys can see that? I know on the YouTube, I know you might be able to. It's a cool little elephant made of wood, carved of wood. All right. Yes, we're using last week's HPMRs. Yes, Quantum Sense. Yes, we are using last week's HPMRs. You got it. You got it. Okay. All the free indicators that I make available for you guys are in the room drive. The ones that are not are the ones that have the V-score, V-profile, and anchor to VWAP. Grab candles, wave, propulsion dots, Darvis, the JT trend. Those are all available. The HPMRs, those are all available free in the room drive. You know, one thing I did not look at today, let's go take a look at this. I am kind of curious about it. And that is, and I will need my trade station for this. Okay. That is the 1 minute chart with some volume profile, well, it's with multiple volume profile nodes. Okay, that's kind of interesting. These, I call these ledges just because I think they're, quite frankly, ledges. Imagine price trying to climb up this, and every one of these is a place for, you know, price action to kind of push off to the next level. This is a place where it's either going to be we miss the grab or we're able to get it and then we move up again. I look at it as a mountain climber. So we're stuck in a pretty, see those two solid white lines there? Those are points of control for two different lookbacks. Look how we're stuck in there. That's interesting. What about the NAS? What did the NAS overcome to get to where it is right now? And see, it's stuck in a volume node too. So you might think, why did that market stop right there? Look at this. Boom. And then some of the volume around it. Volume is a terrific way to determine support and resistance. We talk about volume quite a bit. Volume levels are very important levels. And then if I have a lot of other things kind of happening at the same spot, well, then even better. I might have a price level stacked with a technical level, stacked with a volume level, stacked with a volatility. I mean, that's pretty darn powerful. All right, next up is, so Zion, you took that late V score. That, as long as you know the risk that you're taking, I'm not going to say no, right? As long as you have the risk that you're taking. You quantify it. You can really, really accurately quantify it, you know, with futures as well. But if you're thinking the market might be a little bit more elastic, meaning it's not going to have a solid support level or a solid resistance level. It's going to be soft. It's a little bit cushier, right? Like a beanbag, not the floor. If it's going to be smushy, then I think the better way to deal with smushy levels, elastic levels, is with the options contract or a micro. The problem I have with the micro, if you're using that to deal with higher volatility environments, is that approach will not scale as you start to increase your size. Very rarely do poor micro habits make you a better mini trader. Very rarely. And it's easy to have poor risk management habits when the actual dollar value of each tick is so low that you're willing to take risks that you wouldn't normally take had that position size been bigger or you had a higher number of contracts. Okay. Can I just discuss propulsion dots? Yeah, I know I haven't been talking about them as much for day trading, but they're the crossing of two exponential moving averages, Mike. I mean, that's really all that it is. It's a smart EMA. It's an EMA replacement, because what I'm looking to do with propulsion is have it turn on and off. Moving averages are kind of arrogant. They think they're always important. They think they're always should be listened to. We know very much that the probability of moving averages indicating a good layer of support or resistance, except for the 200, is much lower in CHOP. Well, the propulsion is kind of a way to turn the moving average off when the market gets choppy, because a short exponential moving average will stop crossing with the long and it turns the lights off. And I think that's powerful. and turns them back on in a more ideal scenario for them. But I haven't been talking about them as much, but that's really it. It's their two exponential moving averages that cross and interact with price in a very specific way to activate the dot that would be where, for example, you see this yellow dot on my chart? That's the 13 EMA. Yellow dots on my charts will always be the 13 EMA via the simpler propulsion. Green will always be the 21, and you can see the smaller one here, this magenta, that will always be the 55 EMA. And if you see red ones from occasion, that's always the 8. So when the 8 exponential moving average is active, and where the 8 exponential moving average would be is where those red dots would light up. That's it. Okay. Yeah, those volume levels. Yeah, TOS does have it, but Connor, I'm on TradingView. I don't use the ones on Thinkorswim. I'm actually pulling this up on TradingView, feeding my TradingView chart with my TradeStation. Okay, let's see what else we got here. So we're winding down our session, gang. So if you're on the live stream, we'll be winding down shortly. And this replay will be available both on the Simpler Trading YouTube channel, as well as those of you that were in the room with me today. In the futures room, this will be available in the live trading archive in your member dashboard. Okay. Neil might know more about putting the volume profile lines on Thinkorswim. So when he's on later on, yeah, definitely ask Neil in the futures room. Yeah. Do I find that oil stocks lag futures? It depends on the environment, Adam. I don't want to always say, see, I'm always going to be very, very hesitant to say something leads and something lags. I wish the market were that easy to dissect. But sometimes I would say my preferred environment is where the commodity leads. So sometimes you'll find oil stocks will be doing their own thing because oil stocks are heavily weighted within certain sectors, and you might have one of the heavily weighted stocks of one of those ETFs moving higher for any number of reasons like earnings or news. And they could take the whole ETF up with it while not really having any real effect on the underlying futures contract, right? News specific to a deal that Exxon got is not necessarily going to be good for other stocks or even the crude oil futures contract, but it could be very good for the XLE where Chevron or Exxon is the number 1 and number 2 weighted stocks. So there are going to be those exceptions, right? I want to give you at least the scenarios for the exceptions. But my preferred environment is when the underlying futures contract is leading, is going first, and the oil stocks follow. Same thing with gold. My preference is that. Okay, so let's see. What is V-score high and low? So I'm measuring the standard. So Bala, I'm measuring the standard deviation of volume weighted average price, just so you guys know what the indicator is going to do. And I'm not going to go into more depth on that, but what it is a standard deviation measurement or a Z-score of the volume weighted average price. And the high-low range is simply what's the high. This is so simple. Let me take you back on over to the S&P. So all that is since 7 a.m. Eastern, what's the lowest reading and what's the highest reading of the V-score. That's it. So you look at 7 o'clock. Okay, that's the highest point. That's the lowest point. Great. Now I know. And so you're studying it between 7 and 9:30. Whatever the highest high was in the V-score and whatever the lowest low was in the V-score between 7 and 9:30 a.m., that's your high-low range. That's it. That's it. Yeah, John, I know Neil has a really nice volume profile chart that he shares. Yeah, for sure. Ask Neil for it. He will share it. It's a tool that's free within Thinkorswim. Yeah, so for sure. When is Neil going to be here? Hang on. Neil's going to be here at, bear with me here. Trying to open up my window. Neil will be here at 12:30 Eastern, right after David. Yeah. And then Jack will be here. And then Joe will be here. All right. And by the way, Jack will be doing the open. Will he be doing the open next Monday? He might be. I'll double check if we're going to live stream Jack anytime soon. But Jack will be here after that. So definitely ask Neil. Trader Mo, why do some futures traders use tick charts as opposed to 1 minute? They use a 377 mostly, 1594 for ES. Why do some people like mayonnaise on their hamburger, Trader Mo? That's what they prefer. I can't say that it's, and I'm trying not to be too silly but that's the truth of the matter. It's preference, right? I like smooth peanut butter. My husband likes crunchy. It's just preference. Is there any magic? So if you switch to a 1594, see, really the question our brain is asking is, am I not winning as often as I want to be because I'm using the wrong interval? Or am I not winning as often as I want to be because I'm using the wrong indicator? I wish it was as simple as saying, hey guys, get the V-score and trade a 1 minute chart and your life is going to be easy peasy lemon squeezy. No, any more than switching to, a 1594 tick chart is going to make a difference. Traders who want to interpret price apart from kind of this regimented, I can tell you why they would probably like it. I'm not going to tell you it's going to make all the difference in the world, but a lot of traders do not like the fact that a candle, any kind of candle, is not really showing you anything other than sort of a false view of what happened in a very random 1 minute period of time. People who like tick charts, in many ways, are kind of people after my own heart, to be honest with you, because what they're doing is they're looking at activity. They're looking at how many trades have to transpire before we get a reading, right? Each 1 minute candle isn't under any obligation to have a certain amount of contracts having been traded within it. So one 1 minute candle could be full of 100,000 contracts, and the next one could be 10,000, but you're not going to see it in the candle alone. Ticks are going to have a certain amount of activity implied into the fact that it plotted. So tick charts will be slower during less active times and quicker during very active times. So it gives you that involvement. And a lot of traders really like that involvement feel. I have found a lot of previous floor traders like tick charts. I think because it kind of is probably one of the more floor-like feels once you're taking the floor and putting it on a chart. My 2 cents. They could say, Rog, tick chart users could say, Rog, you're completely off base about that. So I would ask a tick chart user, but I don't use them. Not that there's anything wrong with them, but I don't use them. All right, so let's see here. Does the HPMR indicator show that cloud? Yes. Paul? The zone on the S&P intraday? Yes. Look at this thing. Again, reason number 412, we'll use options when we can, and that we stick to the long side of the market. Look at this, heading right back up. We like the long side of the market. I'm glad that I'm going to be, getting at it today with a slight profit. I really would have liked it to be a little bit more. I don't know what that quick sell-off was before 10:30, but we've recovered. And this is why I will tell you, focus on the long side of the market, gang. Even if you have to buy options so you can sit through some of this. But like I said, I pretty much shut it down. I don't like the narrow range. I don't like that we didn't breach to the upside. This is a very compact day. It's a very compact day. So I just assume. Shut it down. But yeah, as far as preference, that goes down to indicators, right? People ask, people ask me, why don't you use an RSI? Because I use a V-score, right? It's not that you have to use certain indicators, and those indicators are the reason why you're successful. It's knowing what that indicator does and applying it at the right time. And it doesn't matter what it is. It really doesn't. As for as many traders as I know, I probably know each one of them has a slightly different chart layout than the other. Maybe not from an interval standpoint, but definitely from an indicator standpoint. Would I recommend V-score setups after 11:30? ML, I don't want to do anything after 11:30. I'm done. Now, if you do see a V score, I'm not wild about it. You could, but I would do nothing today. Specifically, I would do nothing after 11:30. None of the criteria that I need to be met allows me to do anything after 11:30 today. Okay. Let me tackle a few questions for the live stream, and then we are going to wrap it up. How do I place a stop at an option? Yes, Chrissy, we were talking about the percentage-based value. So what I'm doing is I'm tracking the value of the option, and you can place an alert on Thinkorswim based upon the value of the option. Yes. So it's based on creating a not an alert on the underlying stock, but an alert on the option. So that's what I do there. And for those of you that aren't aware how to do that, it's a very cool thing. So what you're going to do is you're going to create a single alert. So let's go to the SPY, for example. All right, you pull up the SPY, and then you go to single, because you don't want to track the stock. That's now tracking the price of the SPY. You want to track the single, which takes you to the option. I will do the last, at or above, and then make sure that the option that you bought is in this. You have to make sure you're tracking the right strike and expiry, right? And then you simply tell it when that value drop, that option on the bid ask drops below a certain number, let me know. That's it. That's it. You're creating an alert on the single, not on the stock. Stock is the first one on the list. The next one down is single. Now the single just denotes now you're looking at the option, not the underlying chart and price of whatever you bought the option on. Okay, so that's how you do that. That is how you do that. Very narrow ranges today. And again, remember how early we were able to recognize that and react accordingly? Or I should say position size accordingly, using asset classes accordingly. We knew that within the first 17 minutes of the bell, how lethargic this range was. And you can see how it is sort of wishy-washy, right? It's nice to have that read as quickly as we can early in the day to prevent overtrading, to prevent trading too large. Again, we went with the Qs versus the futures. All right, really important there. What else? Do I find the 1 minute chart gives me a better short-term picture of the day trades than say 5? No, Michael, it's what's preferred. Again, I'm going to go back to Michael, thank you for the question. I'm going to go back to my mayonnaise answer. I say mayonnaise because that's one of those weird things that ends up on a hamburger sometimes, and you go, wow, that was oddly good. But no, I think 5's fine. Look, my second favorite time frame after the 1 minute for day trading is the 2. Go figure. I like the 2. After that, yeah, the 5 is fine. The 3 is fine. If you want a slightly longer term, if you want the ability to hang on to trends in a longer way, maybe that take you overnight or at least through the session, the 15 might be good. But I just like the 1. I like the 1. I like seeing those inflection points when I break down the clearing range into 30 candles. Again, some people might go with the tick. There's no harm in that. All the indicators I'm showing you work on a tick chart. I haven't done it. But yeah, all these. So let's say I go out to, so when I do a tick, and I have before, 233 is pretty cool. I'll use a 233. But I'm just going to, for giggles, show you. During active trading times, you can use a shorter tick if you want. There's your indicators. Okay. There you go. So this is now a 233 tick chart. All the indicators are there. So I will usually, and I think a lot of traders do this, they'll use the Fibonacci sequence for their tick numbers, for the tick charts. So if you're looking at the Fibonacci for that, Fibonacci numbers, 377 is pretty popular, 610, 987. Someone mentioned 5094. Well, that's usually a 5097, but it doesn't matter. So some of the more popular tick, and again, if you guys want to use a tick, what I will tell you is this. My indicators and my approach, it's the same thing. They still work. They still work. So let's say I want to go out to a 610. It's going right up the Fibonacci number chain. Now more trades are going to have to transpire before I get a reading. That's it. That's really it. And some of you might like it. Again, I've used tick charts in the past. I don't have a problem with it. I don't think that it does give me anything that dramatically different. But again, I think you're going to find that give or take, the results are going to be about the same. But if you prefer that view, oh gosh, go for it. You saw my indicators work perfectly fine on it. And the same lows that we bottomed out at are going to be, more or less the same readings you're going to get on the tick. Okay. So do the grab candles mean the same thing? Yes, because I'm still measuring the 34 EMA, Connor. We still have open, high, low, close. The only difference between a tick chart and an interval chart is time. We still have an open, high, low, close. But that open, high, low, close that candle will plot only after, in the case of the 5097 or the 610, only after 610 trades have been made will you have an open, high, low, close. In the case of an interval, after 60 seconds have transpired, you'll have an open, high, low, close. So yeah, everything is the same. Yeah, you bet. You bet. All right, gang. So that wraps up our live stream and also our session here in the futures room. I can't say I'm thrilled about that crazy weirdo 1025, 1035 sell-off, because for the most part, I think we were pretty much positioned where I'd want to be positioned and in the right way. But hey, that's it. So I've got a nice win on the Qs, pretty much washed out everything else, just like we talked about. And I'm going to leave with a slight win. Nothing great, but considering the way in which today moved, I'm feeling pretty good. I'm feeling pretty darn good about having navigated this without too much trading and with some slight wins. And some of you who sat through that or even re-entered on that V-score low, kudos, because you get a monster trade on your hands intraday. Very nice. Again, a little bit more aggressive, but once you start to understand what it is I'm doing at these levels and how I'm positioning, you don't have to be restricted by what I do and see, because you are seeing what I'm seeing. And then you can choose a different plan of attack, which is perfectly fine. All right, gang, have a great one. My live stream, folks, there'll be another presentation next Monday, I believe. Just check the YouTube Simpler Trading channel out for that announcement, and I will see you week after next.